The US dollar. It's more than just a piece of paper, it's a symbol of power, influence, and trust. It's the currency we think of when we imagine global trade, international finance, and the pulse of the world economy. From bustling ports to towering financial districts, the dollar is omnipresent. The stock markets, the trading floors, the global indices, they all dance to the rhythm of the dollar. It's the heartbeat of global commerce. For decades, the dollar has reigned supreme, a symbol of American economic might. The American flag flying over Wall Street and the imposing U.S. Federal Reserve building are testaments to this dominance. But this dominance has a flip side, a darker aspect that's increasingly coming into focus: the weaponization of the dollar. This shadow looms large, casting doubt and concern. Countries around the world are growing wary of this power dynamic. They see the international flags and diplomatic meetings, and they understand the stakes. They see how the U.S. can use the dollar to punish its adversaries, to exert pressure, to dictate terms. Sanctions, financial restrictions, and economic penalties are tools in this arsenal. This unease has fueled a movement, a global shift towards de-dollarization. Nations are exploring alternatives, seeking ways to reduce their dependence on the dollar and, in turn, on the U.S. itself. At international summits, discussions about new financial strategies are becoming more frequent. Some are turning to gold, others to digital currencies. The vaults of gold and the rise of digital currency symbols on screens represent this shift. This essay will delve into this complex issue, examining the forces driving de-dollarization. We'll look at the financial charts, the reports, and the data that tell this story. We'll explore the globe with its rotating currency symbols and listen to economists who are analyzing these trends. Their lectures and insights are crucial to understanding the bigger picture, and we'll consider the potential consequences for the future of global finance. As stock market graphs trend downwards and financial analysts discuss these changes in front of world maps, the implications become clear. The world is watching, and the future of the dollar is uncertain. The U.S. wields significant influence over the global financial system. This influence is not just a matter of economic might, but also a strategic tool that shapes global politics and international relations. Much of this power stems from the fact that the dollar is the world's reserve currency. This status means that the US dollar is held in significant quantities by governments and institutions as part of their foreign exchange reserves. This means that countries hold large reserves of US dollars, and a significant portion of international trade is conducted in dollars. The dollar's dominance in global trade and finance provides the U.S. with unparalleled leverage over the international financial system. This gives the U.S. leverage a way to exert pressure on other nations. When the U.S. decides to impose economic measures, it can significantly impact the targeted country's economy and its ability to participate in global trade. One of the most potent tools in America's arsenal is economic sanctions. These sanctions can take various forms, including trade restrictions, asset freezes, and financial prohibitions. The U.S. can impose sanctions on countries it deems hostile or in violation of international norms. These measures are often used to address issues such as human rights abuses, nuclear proliferation, and terrorism. These sanctions can restrict a country's access to the U.S. financial system, making it difficult for them to engage in international trade or access their dollar reserves. This can cripple a nation's economy, leading to significant political and social consequences. Another key element is the SWIFT system, the Society for Worldwide Interbank Financial Telecommunication. SWIFT is a global messaging network used by banks and financial institutions to securely transmit information and instructions through a standardized system of codes. SWIFT is the backbone of the global financial system, facilitating cross-border payments and transactions. It connects over 11,000 financial institutions in more than 200 countries and territories, making it an essential component of international banking. The U.S., due to its influence, can effectively cut off countries from SWIFT, essentially isolating them from the global financial system. This action can have devastating effects on a nation's economy, as it hampers their ability to conduct international trade and financial transactions. Over the years, the U.S. has used sanctions and its control over SWIFT to address various geopolitical challenges. These measures have been both praised for their effectiveness and criticized for their humanitarian impact. the debate continues on the ethical implications and long-term consequences of using economic sanctions as a tool of foreign policy. While they can be effective in bringing about change, they can also lead to unintended hardships for the civilian population of the targeted countries. As the global financial landscape evolves, the role of the US dollar and systems like SWIFT will continue to be pivotal. Understanding these mechanisms is crucial for comprehending the broader dynamics of international relations and global economics. In conclusion, the US's ability to leverage its financial power through sanctions and control over SWIFT underscores the intricate link between economics and geopolitics. It highlights how financial tools can be wielded to influence global events and shape the world order. The freezing of assets is another tactic the US employs to exert economic pressure. This method is part of a broader strategy known as economic sanctions, which aims to influence the behavior of foreign governments by restricting their financial capabilities. By freezing assets, the US can prevent targeted nations from accessing their own money, effectively putting a stranglehold on their economic activities. When the US freezes a country's foreign reserves, it essentially blocks that country's access to its own funds held in US banks or institutions. These reserves are often crucial for maintaining economic stability, as they are used to back the national currency and pay for international trade. Without access to these funds, a country can find itself in a financial crisis, unable to meet its obligations or support its economy. This can cripple an economy, making it difficult for governments to pay for essential imports, service debts, or support their own currencies. The impact is felt across various sectors, from healthcare to infrastructure, as the lack of funds hampers the government's ability to provide basic services. Businesses suffer as well, facing shortages of raw materials and difficulties in conducting international transactions. Think of it as a modern-day siege. Instead of surrounding a city with troops, the US can effectively blockade a country's finances. This financial blockade can be just as devastating as a physical one, cutting off essential supplies and creating widespread hardship. The goal is to pressure the targeted government into changing its policies or behavior, but the collateral damage can be significant. This tactic has been used against countries like Iran, Venezuela, and most recently Russia, raising concerns about the potential for abuse and the impact on innocent civilians. Critics argue that while the intention is to target government officials and elites, the reality is that ordinary people often bear the brunt of the economic hardship. Protests and social unrest can follow, as citizens struggle to cope with the sudden loss of financial stability and access to essential goods and services. The growing unease about the weaponization of the dollar has led many countries to explore ways to reduce their dependence on the US currency. Leading this charge is the BRICS group of nations: Brazil, Russia, India, China, and South Africa. These emerging economies are seeking to establish alternative financial systems that bypass the dollar. They are promoting the use of their own currencies in international trade and exploring the creation of a new reserve currency, backed by a basket of currencies including their own. Section 5, Golden Opportunity, a return to traditional safe havens. Another aspect of de-dollarization is the renewed interest in gold. Historically, gold has been a safe haven asset, a store of value that holds its worth even during times of economic uncertainty. With concerns about the dollar's long-term stability, central banks around the world are increasing their gold reserves. This shift back to gold reflects a broader trend of diversification. Countries are spreading their risk by holding reserves in a variety of assets, not just the US dollar. Section 6. Bilateral trade agreements, sidestepping the dollar. Bilateral trade agreements are another way countries are trying to reduce their reliance on the dollar. In these agreements, two countries agree to conduct trade in their own currencies, bypassing the need for dollar transactions. For example, China has been actively promoting the use of the yuan in trade with its partners, particularly in Asia and Africa. These agreements chip away at the dollar's dominance, albeit gradually. Section 7. The rise of the digital yuan, a new player enters the game. The digital yuan, China's central bank digital currency, represents a potential game-changer in the de-dollarization movement. While still in its early stages, the digital yuan has the potential to challenge the dollar's dominance in cross-border payments. China is promoting the use of the digital yuan in international trade, offering faster and cheaper transactions compared to traditional SWIFT-based systems. If the digital yuan gains wider acceptance, it could erode the dollar's role in global finance. Section 8. A multipolar world, the future of global finance. The push for de-dollarization reflects a broader shift in the global order, a move towards a multipolar world. As emerging economies like China, India, and Brazil gain economic clout, they are seeking a greater say in the international system, including in the realm of finance. The days of the dollar's unchallenged dominance may be numbered. We are witnessing the emergence of a more fragmented, multipolar financial system, with multiple currencies vying for influence. Section 9. Conclusion. Navigating the shifting sands of economic power. The weaponization of the dollar has ignited a global debate about the future of the international monetary system. While the dollar's dominance is unlikely to vanish overnight, the trend towards de-dollarization is undeniable. The world is entering uncharted territory. The outcome of this shift remains uncertain. Will it lead to a more equitable and stable financial order, or will it usher in an era of fragmentation and uncertainty? The answers to these questions will shape the global economy for decades to come.